Hello everyone, my name is Vinita Nair from Vinod Kothari and Company, and this video is to discuss about the concept of high value debt listed entity or an HVDLE. So what is an HVDLE? As the name suggests, it is a debt listed entity of a high value. When I refer to high value, I'm referring to the outstanding principal value of the debt securities which are listed on the stock exchange. This concept was rolled out about 5 years back in around April 2021, where it was felt the need that high value debt listed entities being raising money from the public are required to be governed at par with an equity listed entities, and therefore these entities were subject to the corporate governance norms that are applicable to an equity listed entity. Back then, the threshold for identification as an HVDLE was as low as 500 crore, and the companies were given a transition time because of the requirements in relation to board composition, board committees, policies, related party transaction requirements, subsidiary related governance, etc., required to be complied by them. So there was a transition time given to them, and these entities were expected to comply on a comply or explain basis, wherein if they are not able to comply with particular requirement, they could explain the reason in the corporate governance report and try to achieve the compliance by the time the provisions became mandatory. This last date for the provision becoming mandatory kept on extending, and eventually by April 2025, the provisions then became mandatorily applicable on all the HVDLEs. By then, there was also another set of amendment because it was felt that the limit of 500 crore is too low, and it was increased to 1000 crore to bring it at par with the threshold of a large corporate borrower. And therefore, the March 2025, the amendments were made to the HVDLE regime, wherein the threshold for identification as an HVDLE was increased to 1000 crore. And there were several other amendments made. Mainly, there was a separate chapter, that is Chapter 5A, which was carved out or rolled out in the SEBI listing obligations and disclosure requirement regulations, the LODR regulations, so that there were equity listed entities required to follow one particular chapter, and all the HVDLEs were required to follow a separate chapter to have their separate corporate governance requirements. Now, what was the difference or what was the deviation was that while the chapters got separated, the recent amendments which were made in relation to the corporate governance norms for an equity listed entity in December 2024 were somehow not incorporated in the said chapter. So therefore, there was a gap when it came to the compliance. Rather, the ease of doing business related amendments which were made available to the equity listed entities were not available to an HVDLE. So pursuant to that, in 2025, again, a consultation paper was rolled out where the intent was to align the said chapter with the amendments made for equity listed entity to bring it at par with the benefits or the EODB initiatives available for an equity listed entities. And at the same time, it was also felt that the limit of 1000 crore for identification as an HVDLE is also too insignificant. It needs to be increased given the amount of debt that are raised in each issuance and the cost of compliances, etc. And therefore, it was proposed to increase the limit for identification as HVDLE from 1000 crores to 5000 crores. Now, based on public comments, these initiatives were approved by SEBI in the December 2025 board meeting, and LODR amendments were notified on January 22nd, 2026. The amendments become effective from the date of notification, and therefore this video is to discuss what are the major amendments that have been made and already that become applicable on the HVDLEs, and what are the immediate actionables arising therefrom. So I'll quickly share my screen to discuss on the various amendments made. Yes. So this is only for academic purpose discussion and not to solicit any professional engagement or assignment. So as we were discussing the high value debt listed entities, most significant amendment is that the threshold for identification as a high value debt listed entity stands increased from 1000 crore to 5000 crore. Now, what is the point of time that we need to see in order to ascertain whether an entity gets classified as an HVDLE or not. So one has to look at the date of notification. What is the outstanding value of principal outstanding value of the listed debt securities? If as on Jan 22nd, 2026, the value of listed debt securities is 5,000 crores or more, in that case, the entity will be classified or identified as an HVDLE and required to comply with the corporate governance norm. All the entities which do not meet this requirement or where the outstanding value of debt listed securities is below the particular threshold, in that case, they cease to be identified as an HVDLE. And therefore, the corporate governance norms will not be applicable on such entities. It is also very important to note that the sunset clause. So what is a sunset clause is once the provisions become applicable to an entity and thereafter the threshold, the entity falls below the threshold in the subsequent years, it needs to still comply with the corporate governance requirement for a period of 3 financial years. And in all those 3 financial years, the amount of outstanding debt securities should remain below the threshold. Only then it will cease to be identified as an HUDLE. So that is the transition clause, that for that particular period, continuous period, it has to remain below the threshold, and only then it will get the relaxation of ceasing to be an HUDLE. However, in this case, where you cease to be an HUDLE merely because of the revised threshold, there will be no sunset clause applicable. This has been expressly stated in the amended provisions for absolute clarity. So accordingly, all the entities will have to ascertain what is the extent of their outstanding debt securities listed on the stock exchange, the principal outstanding value. We are not considering the interest amount. We are only looking at the principal outstanding value of debt listed entities. If that is below the threshold of 5,000 crore, it ceases to be an HVDLE. So therefore, the entire corporate governance norms will not apply to such entity. If it is 5,000 crore or above, then it will have to continue complying with the corporate governance norms. Now, just to take some examples, for example, March 31st, 2025. So last year, the threshold was about the amount of debt listed securities was 5,200 crores. And on the date of this notification, if it is below 5,000 crore, the entity ceases to be an HVDLE and therefore Chapter 5A need not be complied with. But if suppose another scenario where the debt listed entity had an outstanding debt of 4,500 crore, and by the time of notification it increased beyond 5,000 crore, in that case the provisions will continue to apply because you qualify as an HVDLE. Another example where the amount was less than 4,900 crores. So amount was 4,900 crore and there was an issuance of unlisted debt securities. Now, in this case, it is pertinent to note that once a debt listed entity will have to be always a debt listed entity because pursuant to regulation 62A, every future or subsequent debt issuance have to be mandatorily listed. So therefore, there cannot be a scenario where an existing debt listed entity can come out with an unlisted debt issuance unless it is covered within certain exemptions or exceptions provided under regulation 62A. Another example is where the outstanding listed debt was about 4,900 crore. And during the year, the company came out with a further issuance of perpetual debt instruments of worth 700 crores. Now, in that case, it is pertinent to note that this will not get added to the outstanding debt securities list because what we are referring to or SEBI is looking at is non-convertible debt security. So outstanding principal value of non-convertible debt securities. This is a defined term in the issue and listing of non-convertible securities regulations of SEBI, wherein debt securities refer to securities with a fixed maturity period. And therefore, perpetual debt instruments, while it classifies or identifies as a non-convertible security, but it is not a non-convertible debt security. Therefore, this will not be considered, and the entity will not be an HVDLE and will not be required to comply with Chapter 5A. Now, how does this impact? If we look at the quantum of entities, so because of this increase from 1,000 crore to 5,000 crore, we need to understand how does it benefit to the listed entities. So if we look at the statistics as on June 30, 2025, there were about 137 entities which had outstanding debt listed amount of 1,000 crore or more. But if you look at the amounts, those entities having the listed debt securities of 5,000 crore or above, it's merely 48. So it's only on 48 entities that this regime will continue to apply, out of which majorly there are entities which are either PSUs or financial sector entities, and others are REITs and InvITs, which are required to follow their own corporate governance norm prescribed in the SEBI regulations. And then remaining only 9 entities are comprised of the corporates, which are neither PSUs nor financial sector entities. However, this number will eventually increase because, as I just explained, that once a debt listed entity is, it is always a debt listed entity. So every further issuance which these entities will make in future will have to be mandatorily listed, and therefore eventually the number of entities covered in the fold of HVDLEs will increase. But as of now, on the date of notification, it is very less. So about only 48, 50 entities which will be required to comply with these requirements. Also, to understand the requirement of sunset clause, like I was mentioning, that once you cease to meet the requirement, you have to be within the threshold for a period of next 3 years, and then you cease to be identified as an HVDLE. But this exception or this requirement is not applicable in case of revision in threshold. So to explain an example, if the outstanding debt as on 22nd January 2026, that's the date of notification of this amendment, if that was 5,000 crore or more, then you are required to comply with the CG norms. Eventually, say in March 2026, there has been some redemption and my outstanding value falls below the 5,000 crore threshold, then in that case, it's not that HVDLE requirements or the CG norms will cease to apply. I'll still be required to comply in the next financial year. Again, we will ascertain the position as on 31st March 2027, whether it is still within the threshold of 5,000 crore. If yes, still you will continue to comply in the next financial year as well. Then in the third financial year, again, we will check. So one is 31st March 26 is the first year. That's when my value was below the threshold. So next 3 consecutive financial years, one will have to see whether you remain within the prescribed threshold or not. So in 27, 28, and 29, in each of these 3 financial years, if the amount of outstanding debt, listed debt, remains within the threshold of 5,000 crore, only then you will cease to be identified as an HVDLE, and then the next financial year you will not be required to comply with the requirements of Chapter 5A. Thereafter, if suppose you happen to meet the requirement again, then again the provisions will become applicable. So the sunset clause is applicable in every case where you have to ascertain whether as on 31st March I continue to remain in HVDLE or not. If I fall below the threshold, then I have to remain in that position for next 3 consecutive financial years in order to fall out of the regime. Similarly, if the provisions become applicable, then you will have a 6 months time, so a 2 quarters time to comply with the requirements. And from the third quarter onwards, you will start reporting the compliances with the CG norms. Now, another amendment was mainly in relation to related party transactions undertaken by the HVDLEs. Just to give a quick background, what was the inherent limitations? As we are all aware that high value debt listed entities were not that are not equity listed entities. They were, most of them were closely held companies. So where it was either in the form of a JV or a wholly owned subsidiary or a closely held company where most of the shareholders or all the shareholders were the related parties. So therefore, once these transactions were crossing the materiality threshold and required shareholders approval, it was not feasible to have the related parties not vote on such transactions. And therefore, there was a situation of deadlock. Thereafter, SEBI rolled out the requirement of, in 2025, SEBI rolled out the requirement of seeking the approval of the debenture holders for material RPTs, because the shareholders' approval had no meaning considering it was closely held companies and all the shareholders were primarily related parties. It was felt that since the interest of the debenture holders are at stake, it is relevant to take their approval to proceed with the material RPT requirement. And that's how the regime was rolled out, where in case of material RPTs, prior approval of the debenture trustees was required. So an NOC from the debenture trustees was required to be obtained, who would in turn take that NOC from the debenture holders, and basis that if you get the requisite approval, that is, if you have an ordinary resolution with the related debenture holders not voting on such transaction. So if the resolution is passed or if the NOC has been obtained, only then you move to the next step of taking a shareholders approval. So this was the regime which was applicable, and 62K was the provision equivalent to that of Regulation 23, which laid down the entire RPT regime for an HVDLE. However, as I mentioned, that because there were some amendments made in Regulation 23 right from December 2024 till November 2025, which were not incorporated in Regulation 62K, there was some sort of gap in both the provisions and the compliance requirement, rather the exemptions or the exceptions for equity listed entity and the debt HVDLEs. So therefore, it was decided to align both the requirements. And in this amendment, what they have done is they have simply made the provisions of Regulation 23, Sub-Regulation 1 to 7 applicable on HVDLEs. So there has been a cross-referencing made to Regulation 23, which provides right from the requirement to have a materiality policy, the thresholds for material RPTs, then the audit committee approval requirements, shareholder approval requirements, then what are the exceptions or exemptions available from RPT approval requirements. So all of these norms that apply to an equity listed entity now become applicable even to an HVDLE. Most important being the materiality threshold. The threshold itself now has been linked with the amount of the turnover, and it's a scale based requirement. So if your turnover increases, the limit will also increase, and the maximum ceiling that is existing is as high as 5,000 crore. So originally it was 10% or 1,000 crore, whichever is lower. Now that has moved to a regime of scale based, where depending on the quantum of turnover, the threshold will be computed, and the maximum threshold for an entity remains at 5,000 crore. So HVDLEs also will avail this benefit, and likewise it will compute what is the materiality threshold applicable and accordingly identify if there are any material RPT requiring debenture holders and shareholders approval or not. Then NOC from debenture holders to be obtained. The SEBI will be prescribing the manner in which this is required to be obtained. So we will await some circular in this regard from SEBI. Also, one thing is on the applicability of the industry standard note. So when we go for approval before the audit committee and the shareholders, you're required to provide certain information in relation to the RPTs. So what becomes relevant is what are those information? We all understand that for an equity listed entity, industry standard note prescribe detailed disclosures to be made in relation to RPTs about 10 crores value. From 1 crore to 10 crores, there is limited set of disclosures which are required to be made. However, this regime is presently not applicable to HVDLEs. HVDLEs are still governed by the disclosure requirements indicated in the SEBI Master Circular of July 2025. So unless there is an express amendment made in these Master Circular, these companies will continue to comply with the existing disclosure requirements. One also deviation remains, or a gap remains, that while Regulation 23 has been made applicable to a debt listed entity, Regulation 23 requires that no RP can vote to approve the transaction when it comes to material RPTs. Now, while this is easy to implement in case of taking approval from the debenture holders, this cannot be implemented when it comes to shareholders, because all the shareholders primarily are related parties. So that was the major reason why the entire regime of taking approval from the debt holders was implemented. So we'll have to read this provision except for the compliance of this requirement. So HVDLEs will obtain approval from the debenture holders, where the related parties who are the debenture holders cannot vote to approve. When it goes to the shareholders, the existing regime of RPs allowed to vote will continue. Another set of amendments were aligning the Chapter 5A with SEBI LODR Third Amendment regulations, which became effective last year. And the alignment was required because there were a lot of exemptions or exceptions granted as an EODB from the ease of doing business perspective to an equity listed entity, which was not applicable to HVDLE. So Chapter 5A has been amended on those lines. For example, the timeline for taking approval from the shareholders is 3 months in case of any new director being appointed on the board. Now, this requirement, while computing that 3 months timeline, the statutory timeline required for taking approval from government or any statutory authority will be excluded. Similarly, this approval will not be required for nominee directors or government or court appointed directors or the directors who are nominated by the debenture trustees. So these provisions which or benefits which were available for an equity listed entity stands extended likewise to HVDLEs as well. Some other clarificatory provisions, like where there is a vacancy in the director's office, and if that results in non-compliance in the committee composition, then the committee composition also needs to be filled or corrected within the set period of 3 months. And if it is caused due to completion of tenure, then before the completion of tenure, that said vacancy has to be filled to ensure that the committee composition remains in line with the LODR requirements. Another amendments include that wherever there is any special business for which the explanatory statement is given, in that case, it has to have the recommendation of the board along with the rationale in the shareholders' notice. Similarly, exemption that was available in the context of equity listed entities while disposing the assets between two wholly owned subsidiaries is also extended to HVDLEs. So we have indicated the requirement for equity listed entity and the corresponding requirement under Chapter 5A and how it has been aligned with that available for an equity listed entity. Another important amendment is in relation to the secretarial auditor. So while the provisions of requirement of secretarial audit and giving a secretarial compliance report is applicable to an HVDLE pursuant to Regulation 62M, the eligibility, qualification, the tenure, and the manner of appointment of secretarial auditor, what was applicable to an equity listed entity, differed from that for an HVDLE. So pursuant to this amendment, that the same has been aligned. So now going forward, even the secretarial auditors of HVDLEs will have to be a peer-reviewed entity, peer-reviewed PCS entity. The tenure will be 5 years in case you're appointing an individual, or maximum 2 terms of 5 years in case of a firm. The appointment will have to be done by the shareholders in the AGM. And if there is any resignation, the board can fill the vacancy till the next AGM, and thereafter again in the AGM, the shareholders will have to approve the another appointment of another secretarial auditor. The eligibility requirements are also being more stringent, where the secretarial auditor cannot be the advisor or cannot give certain list of services, the negative list of services, which has been prescribed by SEBI in its December 31st, 2024 circular, as well as clarified by SEBI FAQs and the ICSI circular on the list of services. So wherein while they can provide the regular attestation like a scrutinizer's report or e-form attestation, etc., but they cannot undertake vetting of annual report or giving advisory services, etc., in order to maintain that independence and ensure that maker-checker thing is ensured. So this is again an important actionable. While it should not impact the existing tenure, because all the entities must have already appointed the secretarial auditor for FY 25-26, and the AGM has already been concluded. So there is no scope to go for the appointment for the existing year, and therefore this requirement will apply for secretarial auditors appointed for financial year commencing from 1st April 2026 onwards. So in the next ensuing AGM, the companies will have to take the appointment of the secretarial auditor before the shareholders and have it approved for a period of 5 years. The existing tenure, whatever they have served, should not get impacted, because these were the benefits which were available for equity listed entities as well when this regime became applicable from 1st April 25. So likewise, all that interpretation and relaxations should also apply to the HVDLE, once they are required to comply with the requirements. Similarly, the secretarial compliance report or the ASE report also needs to be submitted by a peer-reviewed company secretary, or the secretarial auditor can also furnish the same, but whoever furnishes will have to fulfill the eligibility requirements in relation to Regulation 24A. So with this, the major actionables that arise is that companies need to first ascertain whether as on Jan 22nd, 2026, they classify as an HVDLE or not. If yes, then it needs to undertake the actionables, primarily aligning their RPT policy with the amended requirements, and also evaluating the eligibility of the secretarial auditor to be appointed for the next year and taking it up in the AGM, where the appointment will be made for a block of 5 years. Likewise, the entities ceasing to be HVDLEs as on Jan 22nd will have to evaluate whether they can dissolve the committees and do away with the policies. But at that point of time, they'll also have to take note of the other requirements. For example, an NBFC will have to refer if they get covered in the scale-based directions and required to have those committees or not. Likewise, SEBI regulated entities will have to look at their respective statute. So if those permit, then these entities can do away with the mandatory committees, because now as they cease to be an HVDLE. So I hope this video gives you the clarity on the amendment and also what are the actionables involved. You can refer to our articles. We have provided the link in the description box, and you can refer to our FAQs and article in this regard. Thank you very much.